by the time we're finished with this presentation, you are going to know more than the average life insurance agent about how life insurance works. Anybody think that's cool? Yeah. All right, so here we go. So there's two types of life insurance. There is permanent insurance, and there is term insurance. There's two kinds of permanent insurance. There's whole life, and there's universal life. There's a couple types of term insurance as well. There is 1-year renewable term, and there is level premium term insurance. But what do these things mean other than just words? We'll look at the concepts now behind them and see why they're named these different names, and you'll understand what products are good, what products are not, and why you would either want to buy or stay away from them. So the first type of insurance we're going to look at is term insurance. It's called term insurance because it's a type of life insurance policy that pays a death benefit, provides coverage for a certain amount of period or a specified term of years. Term insurance, we'll look at the 1-year renewable term first. And what it looks like is you have a death benefit that you're purchasing, and you have premiums. And the premiums rise based on your age and the amount of coverage. So if you're real young, you'll get in at a low rate. Premiums are like next to nothing for someone young buying term. As the years progress and you get older, the premiums go up accordingly. With 1-year renewable term insurance, when you buy the policy, you have a certain fee for that year. And the next year, if you want to renew and keep your coverage, you have another premium to pay, and it's higher this year. So you're always paying on a stair-step pattern. There's another type of insurance now that's called level premium term insurance, and what it does is it takes an average of the amount of term that you want. So if you want 10, 15, 20 years, it's going to average the amount of premiums that you'll pay and then give you a little discount. It's very nice, and you know the premiums, if you buy 20 years, you know for 20 years your premium is going to be X. It's not going to be X plus, 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 plus each year. And this is nice. Level premium term insurance also has something that we really, really, really like, and it's called a convertibility option. The convertible term insurance is such a beautiful thing, and we'll go into it more later, but remember, it's convertible term insurance that we like, it's convertible level term insurance that we love. Now we'll talk about universal life insurance, and universal life insurance has been around for a while. It's a kind of the new insurance, and insurance companies love it because universal life insurance takes the risk from the insurance company and it puts it on you as the client. And they're kind of a fan of that because insurance companies, insurance is supposed to take risk away from you, but the insurance companies can make more money if they put the risk back onto you, right? So they're kind of a fan of this. They like their agents to sell this because it's taking the risk from them, and that makes sense. So universal life insurance offers the low-cost protection of term insurance with a cash or savings element that provides access to cash. And this is how it looks. You have a death benefit when you buy a universal life policy. Plus, you have a cash fund that will grow over the years. And they say, and for this, you can have a flexible premium. So, for example, if you want to buy in this year at X, and next year you want to pay a little more, you can. That's nice. Well, maybe the next year, it's not doing so well, or you want to use the money elsewhere, you can just pay a little tiny bit, and you'll still have all your coverage. Isn't that nice? Flexible premium. Universal is talking about the coverage amount. Flexible premium talks about the premium. And they said this is a nice policy. But let's look at inside now and see what actually is happening inside the universal life policy and why it may not be such a nice policy. The universal policies work like this. You pay your premiums, and those premiums go into your cash account inside the policy. From the cash account, the money is taken out and put into these different investments. Especially if it's indexed, this is exactly what it's doing. It goes out into these investments, a wide variety, and then the investments make a return. And they return back to the cash account. So this money is going from you into the cash account, over to the investments, coming back, oftentimes the universal policies also have a % cap rate inside the policy. So let's say, for example, that you pay your premiums and they go invest in these different investments. Well, if the investment does really well, that should be good news for you, right? If the investment does bad, that could be bad news. But the insurance company says, oh no, 0% cap, you're capped at 0. So if the investment does bad, you won't lose, you won't have to pay anything for it if it goes negative. But they also put a cap on the top as well. So if the investment does super well and you're capped at 7% is what you get back, even if the investment did well, like 15 or 16%. Then once the money comes back in from the investment to the cash account, they take premiums for the death benefit. So they take the money out there, and this is also the cash account that takes the fees and surrender charges that the policy may have. So now what happens with these insurance policies that we see that are suddenly requiring more premium? Why would that be? I mean, if this is happening and the investments are working like they should, shouldn't it be okay? Well, the investment, this is what we have to remember with the universal life policies. Life insurance policies here, with the universal products, the death benefit is based, I got ahead of myself. So we have death benefit, plus, now we'll look at the way they really perform. Death benefit, yes, plus a cash fund that actually grows more like this. So it grows for a while and then it drops off. And when it does that, look what happens to the premiums. So we ask, why? Why does this happen to the premiums? The cash account did well, and then it started going down, and suddenly you're having to pay premiums. Why? It's based on the foundation that this policy is built on. And that foundation is the 1-year renewable term, which is the most expensive kind of term insurance that you could possibly purchase. This term insurance, as you go through the years of the policy, and you have your flexible premium, the premium's coming from that cash fund. Every year it increases, the premium amount. You may not be increasing what you're paying in. You may actually be decreasing because you're using that flexible option. But the premium for the coverage is increasing. And so what happens when all the money in the cash account is used up? You either have to make the payments or your coverage goes away. We have a sad example to look at now of exactly what happened with the universal life insurance policy that somebody brought to our office that did just this. Here's the actual illustration. This came to the office. I took out the company name and the client's name and all the personal information. But this is what he brought to us. He's 45 when he purchased this policy. He's paying $4,000 a year into this policy for $1 million of coverage. That's pretty good. Now he's 62, 17 years later. He comes to us because he says, my insurance wants me to pay more premiums to keep my coverage, and I can't afford the premiums. So can you do something to help me? So we took a look at his policy. Total premiums that he has paid to this point are almost $62,000. He has a fund value in his policy of $14,000, almost $15,000 that he could access if he wanted to take money from this policy. He has a surrender value of $5,524. So that means if he decided to get rid of the policy and said, I'm done with it, just give me what I can get, they would send him a check for $5,524. He has a death benefit of $1 million. Next year, though, and this is why he was concerned, and he came to us, he'll be 63 years old. He'll have paid almost $66,000 in premium by that time. He'll have a fund value with 0, a surrender value of 0, and a death benefit of 0. Is this a good deal for the insurance company? He was 45 when he purchased this policy. He was in good health when he purchased this policy. He got the very best rating possible when he purchased this policy. He's 17 years older now. He goes to apply for a new policy. His health has changed. He does not get a good rating now. He has to pay a lot more for this coverage. He wanted this coverage for his kids. We went to underwriting. We tried to get him a policy. the premium that came back, he said, I can't afford it. Guess what? There's no legacy for the kids. It's really sad. And New York Times had something to say about this in 2016, about why insurance premiums are skyrocketing. And they said, by the way, here are the guarantees. Guaranteed 0, non-guaranteed, even if it performed well, still 0. But New York Times said, the money in the accumulated cash account can be used to help pay the policy's premium, but there is a risk. Because if the money runs out, the policy lapses, there's no coverage left. And the article went on to say, not to be morbid, and don't take this the wrong way, but your mother really needs to die. Because she was the one insured. Her premiums were increasing. So I guess you have two options when you purchase universal life insurance. You can either purchase it knowing that the coverage will go away someday, that you'll pay a lot of money into these policies that aren't worth it, or you could just plan to die before the policy runs out. I don't think he wants to be dying at age 62. I wouldn't. And so, contacting the insurance company, they tell us lots of people exchange their universal life policies that aren't performing to permanent insurance, whole life insurance. At least it happen every day. But it's sad all the same. So there's the question, why do people sell these kinds of products if they're so horrible? And it really comes down, I think, to commissions. So let's talk a little bit about how commissions are made and how commissions are earned. And so you can understand exactly how they work, you'll know where they're coming from, and it'll help you maybe to get a little clearer picture of what's happening. Commissions, unlike when you sell or when you purchase a home or you purchase a car, are different with the insurance company. When you purchase a home or car, you pay the money, and then a portion of that goes to the agent or the sales rep, whoever sold you the car. That's their commission, right? So you're paying higher to pay them. That's fine. With the insurance company, it's a bit different. The insurance company has these products that they offer. When you buy a policy, you pay the money to the insurance company, and they put it directly into whatever product you bought. All the money that you paid is purchasing you insurance. Then the insurance company also has something that they call their general fund. This general fund is what they use to help pay the utilities so that they can have lights at the insurance company's office. They can have computers to calculate the transactions or to, set up programs so that you can see your policy online. They use this fund to pay their employees that are there running the insurance companies, helping you to take loans or processing paperwork. They also pay their underwriters out of this. They also pay their agents out of this. So when your policy is purchased, they look at the policy, they look at the amount, they look at the type of policy that it is, and they say to their agent, out of our general fund, this is what you earned. Now, commissions with the insurance company, of the products that they sell, the products that pay the highest commission are the products that decrease the insurance company's risk, obviously, because they know that if you purchase a permanent whole life policy, they have a longer amount they have to guarantee, right? They have to guarantee it for your whole life. And they know they're going to be paying a death benefit someday, so they need to keep the money, use the money wisely so that it's there when they need it. So commissions are highest on the products that carry less risk, pose less risk to the insurance company, term and the universal life products. I have something to show you. Who would like to see a universal life policy, like a contract, an actual contract? So I have one here. We received this from one of our clients she didn't buy this through our office, but she sent it to us, and I have it here to show you guys. This is a universal life contract right here. And see all these? These are all the places that I've marked with things that they can do to change your policy, or fees they can do after you purchase the policy, things they can do to change it, decrease your death benefit, increase your premium, change your guarantees, change all kinds of things after the policy is purchased. These are the flags for that. Look how thick this thing is. This is not an application. This is just the policy. Would you want to read this? We did, and we highlighted it, and we marked it. Who would like to see a whole life policy? I have one here too. This is a whole life policy right here. There's one flag. This page here, this little highlight, it's a rider, and it says they can charge $150 if you exercise the rider. One-time charge when you use the rider. That's it. Otherwise, it's all solid guarantees. A little bit thinner too, huh? Which one do you think you might prefer? The big fat one with lots of things you can change, or they can change on you, or the thin one with just the one change on the rider? Me too. So now let's talk about the whole life insurance and see exactly how it's built and how it works. So whole life insurance is a type of life insurance that pays a benefit on the insured when the insured dies, and it also accumulates a cash value. Whole life insurance looks like this as illustrated. There's a death benefit, there's a cash value, and there's a premium. And it's a level premium for life. Whole life. That's the reason it has its name. It's got a level premium for life, whole life. The cash in the policy also has to rise to equal the death benefit at the time the policy endows. And when I say endows, that means either age 100 or age 121 based on the tables the insurance company is using to write the policy. So this is the basic structure of the whole life policy, is permanent insurance. As long as you pay the premium, the level premium each year, you have the coverage. There's also something called paid-up additions. And paid-up additions is something that we add to all the life insurance policies, the whole life insurance policies that we write. And this is a very neat feature because what it does is it increases the amount of cash value available to you. Because with traditional whole life policies, the policies start out with no cash value at all. Because it has to take time they're buying you mostly insurance, and then over time, as the costs of that insurance, they've recouped that, they can add to the cash value. But with paid-up additions, you fund it specifically to buy that paid-up insurance, which creates the cash value. So look what happens. You buy a paid-up additions, and your death benefit increases slightly, which means cash value has to increase, right? Because it has to meet. And it starts out a little sooner. So that's exactly what it does. Now, there's something also called participating whole life insurance. And I love this part. Because participating whole life insurance means that the company is a mutual company and you can participate in the earnings of the company. So some companies are stock-held companies, some companies are mutual companies. Stock-held companies, they make earnings and they can show growth, profit, and they share it with all their stockholders. Mutual companies earn a profit and they share it with all their owners, the owners of the insurance company. As a policy owner, you are a part owner in the insurance company, so guess what? You can share in their profits. So participating whole life insurance means you can participate, and when you participate, it's called a dividend. They'll give it to you, and the dividends we have them purchase paid-up insurance, paid-up additions. Makes sense, because it's going to increase your death benefit and increase your cash value. And that's done with dividends. Now, dividends work kind of in a special way. Dividends are paid to the owners of the insurance company based on how much of an owner you are. So, for example, Jane, let's say you and I are twins. And we both purchase policies. I purchase, let's say we purchase policies for $10,000 each. And we're twins, we're both healthy, we get the same rating, we have identical stuff. However, I am a pilot. and you're not. So I pose more risk to the insurance company, right? And so my dividends are going to be less because I'm a more risky person. Therefore, most of my premium, or more of my premium, I should say, is going to satisfy the insurance company that they can pay a claim if need be. So my policy is going to start out a little bit different than yours, even though we pay identical premiums. So dividends, when dividend time comes around, because Jane has more ownership in the company, she's less risky to them, they pay her the higher dividend. We have the same premium. So that's how it works. And there's other types of things that they calculate those dividend changes on. Some of those are, tobacco use, marijuana, extreme hiking, skydiving, again, you see flying, snowmobiling, really hazardous exercises and activities. So now we have to talk a little bit about ratings and how the insurance company decides what rating to give you. Do they just draw it out of a hat and say, oh, preferred? Okay, here you go. And let's draw again. Oh, standard, here you go. No, they have a very systematic way of doing this, and it's a beautiful process. So ratings are determined, and they're based on a large group of people, large law of numbers. So they take this group of people and they assess them. And they say, okay, out of these people here, we have a rate chart now. We found that some of these individuals, most of the individuals, were in standard health. So this is our standard rating. They're the average American. We found some people that were actually healthier than the average American, so we're going to call those preferred people. And we found some that were even healthier than the preferred people, so we're going to call those super preferred. But there were also some that weren't quite into the standard category, and so we're going to call those Table 2 or Table B. And then there were some that were not even Table B. They were a little bit less than that, so we're going to call those Table C. And likewise, and so they go D, E, F, G, H, I, J, as long as they need to go. They put all that into their chart. And then 2 people apply for a policy. And they look at that chart, and they assess their health, and they measure it to what they have the guidelines for, what the actuary said, the law of large numbers, what they got from that big group of people that they analyzed. And for this example, let's say that this lady, she got a super preferred rating, and the gentleman got a Table B rating. The insurance companies always give their best ratings possible. And so even if this gentleman's standard, below standard for some reason, maybe he carries a few extra pounds than the average American would. And so that's okay. He's going to get his very best rating possible. The insurance company always makes sure that happens. Now, let's say a few years down the road, they apply again. This time, some things have changed with their health. The insurance company is all about giving the best rating. This lady gets a standard rating this time when she applies. Something changed with her health. Maybe she had somebody die in her family, and maybe a sibling died of cancer, and maybe something happened with her own health. And now she's the average standard. That's fine. The gentleman also applies. And his health was better. So how great is that? He gets select this time. He's better than standard. What happens to his policy that he had already? Well, if he's applied with the same company, the insurance company is going to say, oh, look, congratulations, you qualify for a better health rating. Maybe you lost those few extra pounds. Maybe you've been doing some exercises and you've really been working on your health, and we see that, and that's a great thing. We're going to move your policy up to select. So now both of his rates, he gets a rate change, so his premium changes. Now his policy is at the good rate, the select rate. What happens to the lady's policy? She was super preferred, now she's standard. Nothing happens. The insurance company says, back then you were super preferred. And we underwrote it, and that's what we agreed upon, that's where you'll stay. Because they always give you the very best that they can. So now we need to talk a little bit about ratings and term insurance and how the convertible term insurance that we love so much comes into play. So this gentleman, this is a true story. This gentleman applies to our office and he gets some policies. He is approved, super preferred. So he purchased term insurance. He bought $1 million of coverage. Perfect. Now, a few years later, he says, I think I'm ready for a whole life policy. I've been saving my money, and I've been working, and I think I can make these premium payments just fine, no problem. So he applies again to the insurance company. Well, this time, something had changed with his health, and he got below standard. And the premiums for the below standard, he did an analysis, and he looked at those, and he says, I just am not comfortable with that, so I don't think I'll take that policy. Instead, what I want to do is I want to convert some of my term insurance. So he has $1 million of coverage over here. So what do? We tell the insurance company, we would like to have a whole life policy now for this gentleman from his term insurance. So they split it out. And they say, okay, he can have $600,000 of term insurance, and we'll give him the whole life policy that he was looking for at the super preferred rates, because he qualified for that when he first applied. And so no matter what changed in his health, because he had that $1 million of coverage in term insurance, he can have $1 million in whole life insurance by converting that, no problem. He can convert this policy now. So you see he converts some of it, $400. He still has $600,000 in term. So a couple years go by and he wants another policy. Guess what? He can get another policy at super preferred rates just by converting the term. And he could do it again. In the meanwhile, he has a chance to work on his health a little bit and see if he can, change any ratings there. If he can't, he has the super preferred. If he can, that's awesome too. So now there comes a question. People want to know, how much insurance can I have? Because are there maximums and minimums? Yes, there are. So the insurance company, we're going to do a little exercise here about how much insurance you can have, and you're going to figure out how much insurance that you can have based on the insurance company's guidelines. There's two factors that come into play: age and income. So what I want you to do on your paper right now is to just jot yourself a little note about how much you make. Just put it down, just personal to yourself. And now, here are the ages, and here's the income factor. Now, based on your age, or your age group, so if you're age 18 through 40, you're going to write 25 down beside your little note. If you're 41 through 50, you're going to write 20 down beside your little note. If you're 51 through 60, you're going to write 15. 61 through 65, you'll write 10. If you're 66 to 70, you're going to write 5. If you're over 70, write a little star, because this means you're special, and we will do a consideration to know how much insurance you can have. And now what you're going to do is you're going to multiply your income by the little number that you wrote down. Is this surprising anyone at all about how much insurance you could actually have? Is anybody here underinsured based on the insurance company? Is anybody overinsured? You have too much? It's kind of a neat exercise. The insurance company will allow you to have this much just for the asking, if you're, based on your health. Now, I saw when my mom asked how many business owners were in the room, a lot of hands went up. These are personal amounts. So this is what you can have based on your personal income. This is how much life insurance you can have personally. Now, there's some strategies we can do with business that go on top of what you can have personally, which is cool as well. And now, another question. Who should I insure? I have a family. I have 2 little kids. And I've noticed that if we buy a policy on, the dad, we're going to pay about $13,000 for $300,000 of coverage. But if we buy it on the 10-year-old, we'll just have to pay less than half that for the same amount of coverage. Shouldn't I buy it on my child because it's less expensive? Good thinking. But here's something to consider. When you pay a premium, the higher the premium is, the more cash value can grow in the policy. Also, because children, there's less premium dollars, takes less money to insure a child's life because they're so young. It limits the amount of cash buildup you can have in that policy, because you're paying a small premium, you're going to have a small cash value relative to the premium. And children's insurance is based on how much their parents have. So if you don't have any insurance, there's no way the insurance company is going to let you have a policy for your child. They say, what? He doesn't have any insurance? They don't have any insurance on their life, but they want to insure their child? What are they planning to do with a child? That's their thinking. And so we come back to the analogy, how many flew here on a plane? Can I see your hands? Lots of you. Very good. When they did the safety brief, they talked about the oxygen mask, right? If the cabin should lose pressure, an oxygen mask will appear. Grab it, pull it towards you, and secure it over your mouth and nose, securing with the elastic straps. Although the bag may not inflate, oxygen will be flowing, but place your own mask first before assisting your child. The same is true in insurance. Buy a policy for yourself before buying on your children. It's a rule of thumb, good rule of thumb. Because what happens if you've purchased a policy for your child and something happens to you? What have you left them? Premium payments? Premium payments? What happens if you purchase a policy on yourself and something happened to you? What have you left them? Money to make premium payments. So a good strategy also is to purchase a policy for the parents and then get one for the children. Because now if something happens to you, those premiums are covered. There's a couple other options that you can do. There's also something called a family plan, which allows you as a parent to purchase a policy and also add your minor children as a rider onto the policy, so you can insure everybody at the same time. So dad buys a policy and he adds the rider. So now all his kids are covered. All the minor children under 18 are covered. Now what happens if they have another baby or they adopt another child? Well, that child can just be added onto the rider. No extra cost. All they have to show is a birth certificate. There's also one other thing for children. And this is cool because it's like buying term insurance for children. Did you know something? Children cannot get term insurance. It's way too much insurance for too little premium. The insurance companies won't allow it. And so they can get something called a guaranteed insurability option. And what that is it's basically term insurance for kids. And you add it onto the policy. It's a paid-for rider, so you add it on, and then the insurance company will give you options. And they say, okay, when child is 21 years old, you can convert X amount of insurance. You can add this much more insurance onto their policy. Or you can buy a new policy for this amount of insurance, no more underwriting necessary. And then when they're age 28, you can do the same thing. And when they're age 34, you can do the same thing, and so on. And so that's nice because that gives children another option. It gives them some basic term insurance, for lack of a better word. Because what happens if you insure your child and something happens between the time you insure them and the time they're 18 and they can no longer get a policy? That's happened to some of our clients. So, fortunately, they had the guaranteed insurability option rider, and now they can continue to add insurance on their lives even though they are, quote, uninsurable. It's a very nice option to have. So what we like to do here at Life Benefits is whenever somebody comes to us, a client comes to us, we like to give them as many options as are available. We don't ever want to set them down this narrow hallway and say, if you just go straight, you'll be all right. Because little curves and bumps come up. So we want as many options on the table as possible so that, given a situation comes up that is not desirable or a little less than what was planned, you can grab one of those options and still have a very nice policy that works well and a plan that will keep your future solid. That's what I have for now. Thank you very much.